My crystal ball and I were too optimistic about the situation. War has begun. Welcome to the show. Today is Monday, March 2nd, 2026. Our first headline today: War equals stimulus. Risk on day minus metals. Defensive sectors and areas pulled back today, including healthcare ETF dropping 1%. Consumer staples dropping 1.5%, utilities dropping 0.75%, TLT down 1.33%, and despite the 2-year Treasury note yield gaining 9 basis points, the 10-year Treasury note yield also gaining 9 basis points. The small caps actually went up on the day. The NASDAQ actually closed up on the day alongside other risky on type things. ARK-K rising almost 2% today, and Bitcoin going up 5.5% today. So the liquidity oracle is rising, and there was a bit of rotation from safety to risk on areas. This is typical of war because there's a lot of spending, which is very stimulatory because of money, more money being expected to be paid by the federal government. So even though crude oil is up about 6%, markets were able to show risk-on sentiment because of the stimulatory effects. We even had credit spreads actually tighten today. Yeah, it's important to adjust for the dividends. We had a dividend on HYG, so if you're not paying attention, you might have thought they spread. They actually tightened slightly today. Now, not everything is adding up to be telling the same story. Typically, that type of stimulus is, inflation shock from oil going up on top of the stimulus that happens because of war. And the 10-year break-even inflation rate only rose by 4 basis points today, getting back to a range that we were just at last Thursday. So, the main thing here is we got to wait for the dust to settle, give it a few days to see if there's really any changes in trend, because metals also did something completely opposite to what the rest of the market was doing. Gold went up. That's a risk-off type of play for gold to rise. And this is against a rising dollar today, too. All while industrial metals actually said risk off. And remember, Dr. Copper with a PhD in economics, it's a common phrase on Wall Street. It's not taking off like a rocket ship as you might think it would based on the scenario we're in. We actually fell back 1.5% today, alongside silver actually falling 4.75% today. I think a lot of markets were already pricing what had happened over the weekend ahead of time, like they were expecting it, and so normally you'd get a rush into treasuries, but treasuries had already gone up, and so it actually did the opposite. The main thing now is how long is this escalation going to last? How long will crude oil stay elevated? I mean, you can bet pretty strongly when and if this ends, Iranian oil will no longer be sanctioned, assumably that it does end, and we're going to have even more oil than we had before. So the only real question is, how long is this going to last? If it extends much longer than what markets and what other people are expecting, then yeah, crude oil can keep going higher, especially because as far as I understand right now, the Strait of Hormuz is actually closed, which does have an effect on crude oil prices. Me and my crystal ball will not lose our optimism on the situation, and I'll continue to side that things will resolve sooner than later. We can only hope. On to community topics. On merch, I was recently just offered to join the affiliate program on YouTube. I've decided for now to have, you sometimes see me wearing vests. I love vests, and I can apparently sell them in my store through YouTube. And when you buy something by clicking on those links, you support the channel, you support my work. So I have vests. I currently have this exact crystal ball actually in the merch section if you want to get your own. And I'm currently planning to add more things to that as time goes on, maybe alongside book reviews and that kind of a thing. And then second community topic as far as moves go, like, for the Robschild portfolio, I mean, I'm sort of just waiting for the dust to settle at this point. At least settle after this knee-jerk reaction in markets. Like, will there be trend changes now? Or is this just a bounce going in the same direction, assuming that things will resolve sooner than later? I can say that the longer that this goes on for, the worse it is for bonds, by the way, because higher government spending is just not good for bonds. So right now the consensus seems to be that it will last for a few weeks. And it could be longer and it could be shorter. You'd need a crystal ball for that one. Coming up Wednesday, we have ADP jobs employment. Now that we have this other thing to focus on, I'm wondering if the government's going to be willing to let loose some more real data. I mean, think about all of this government data that we've been getting with all of these insane revisions to the downside. And that's not really the ADP, but, for Thursday, the weekly jobless claims, continued claims, and initial claims. Also Friday, the big employment report. I don't want to be a conspiracy theorist or anything like this, but I could see how it would be beneficial to try to slip this, any shocking data under the radar while the headlines are not going to have anything other than this current situation we're in. So, but anyway, coming up, the end of the war, whenever that will happen. And don't forget about those tariff updates. Those are still not completely gone as far as I know. I appreciate all of you for watching, liking, subscribing, sharing, commenting, and all of your support. Much appreciated. On to more charts. The S&P 500 went completely flat today. We were up 4 basis points. One of the tailwinds for the stock market in general, I think, is software has been getting beaten down majorly over worries over AI, and it's sort of floating back up. Semiconductors, Nvidia went up, but the whole index actually went completely flat. 0 basis points of a movement from close to close from Friday to today, because the rest of the semiconductors actually went down. Berkshire got hit pretty hard today, going down almost 5%. Aerospace and defense went up a bit today. And as I said earlier, the defensive areas, consumer defensive, actually dropped alongside utilities and healthcare and energy, obviously going up because of the oil shock right now. The VIX popped on the open to an intraday high of around 25 and settled down, still above 20, but not a lot above 20 at 21. And interestingly, the VVIX, the volatility of volatility, it's in caution zone, but it's not in panic zone. If you were to ask me where will the VVIX be if this is hitting the news, I'd say this is definitely in panic zone, and it's not. So I found that to be interesting. As mentioned earlier, I want to reiterate, credit spreads actually tightened today. HYG divided by SHI adjusted for dividends actually rose a little bit. Alongside metals, XLF is another area that did not show risk on, like everything's fine. Does this chart look bullish to you? XLF actually fell by 0.25% today. And as I said earlier, I think markets must have been pricing a lot of this in already because, yes, Lockheed Martin, defense companies, they went up today, but only 2.8%. You think, this kind of thing might skyrocket these kinds of stocks much further. And RTX did go up 4.7%, but notably not much higher. I think the markets are generally agreeing that this will last a few weeks. That's sort of what everything's saying right now. As expectations evolve, markets will be reflecting that. Last chart of the day, Nvidia, the king of the stock market, still, in my opinion, in a very, very clear head and shoulders pattern. I said on Friday it was pretty clear we're headed down to the neckline. It still looks like that's going to happen, but we did get a bounce today in Nvidia. It's very easy for me to see a major turnaround Tuesday, specifically in the bond market tomorrow, alongside defensive stocks. That would make a lot of sense to me for a lot of reasons, but what do I know? I'm just a guy with a crystal ball, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.